Well, thank you very much. And I just want to congratulate everybody. The stock market, Dow Jones Industrial Average just hit 30,000, which is the highest in history. We've never broken 30,000, and that's just despite everything that's taken place. The stock market's just broken 30,000. Never been broken, that number. That's a sacred number, 30,000. Nobody thought they'd ever see it. And it's the 48th time that we've broken records. And I just want to congratulate all the people within the administration that work so hard. And most importantly, I want to congratulate the people of our country, because there are no people like you. Thank you very much, everyone.
Welcome, everybody, to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks broadly had another very green day, capping off a stellar week. We saw the large caps underperform, the broader market gained, defensives gained, cyclicals gained, sensitives gained. Google, Meta, Amazon, Nvidia were lackluster here today. Apple and Microsoft held up the mega caps. And when you have financials, software, industrials, cyclicals heavily in the green, you're going to get a very, very positive day. And that's exactly what we saw. The only two red sectors that were down today was the XLC, and that's because of Meta and Google. And then the utility sector down 0.55%. Other than that, technology was flat, the XLK, healthcare was flat, and they all underperformed the SPY, which returned 0.31% on the day. But then we really saw Trump trades take focus today. XLY, mostly on the back of Tesla. The industrial sector, that's a heavy Trump trade, as well as financials, all up in excess of 1%, really leading the charge today. But again, broad-based gains across the board. There were only two sectors that didn't perform well, and that was due to individual names, stuff like Google and what's happening with the DOJ. Looking at the last 5 days of trade, every sector was in the green. Look at the worst performing sector this week, guys. Healthcare up 1.63%. Like, anytime a sector returns 1.6% for the week, that's a great week. So it really goes to show the type of week we had here today. And it wasn't even the week. It was really just the last couple of days, probably from like mid-Wednesday, where we really saw like a bottom put in and then just a striking rally to weekly highs. And that tends to happen in November. The seasonality of November tends to see a bottom put in sort of around this time frame, and then we move onward and upward into December, into the end of the year. I've spoken about that ad nauseum, especially with seasonality, guys. The best performing sector this week was materials, but we also saw outperformance in utilities, and maybe that's why we actually saw a bit of a pullback, because they just performed so well coming up into Friday. But we saw energy gain, real estate, industrial, staples, even technology was up 2.12%. But the cake on top of everything was really just small caps. The RTY up 4.27%, completely outperforming second place, which was the best performing sector for the week. However, the weak spots definitely were these mega cap names, the S&P 500, the Nasdaq 100, the weakest sectors of the bunch. And we certainly are seeing a bit of a rotation, probably out of some of these bigger names into the broader market. But that's not to say that the rotation has seen declines in those sectors. We are still seeing net buying, all things in aggregate. And along with the Trump trades we got this week, industrials outperforming, financials outperforming, small caps outperforming. What added fuel to the fire today was the economic data we got, particularly with the PMIs. Now, US economic output is roaring as businesses prepare for lower interest rates and new administration in Washington. S&P Global's flash US composite PMI, which captures activity in both the services and manufacturing sector, came in at 55.3 in November, up from 54.1 in October. Economists actually expected the index to tick up to 54.1, so we actually did see a beat, and this was some of the fastest business expansion since April of 2022. And when we dive into the specifics, looking at services and manufacturing, again, look at the consensus, 48.8, manufacturing came in line, services 57, the consensus was 55.2, and that's why we saw a handily beat. And the business mood has really brightened in November since the Trump election, with confidence about the year ahead hitting a 2.5 with confidence in the year ahead hitting a 2.5-year high, the prospects of lower interest rates and a more pro-business approach from the incoming administration has fueled greater optimism, in turn helping drive output and the order book inflows higher in November. And so guys, manufacturing could finally be coming out of the recession it's been in, particularly the manufacturing side, and that's why we actually saw outperformance in names like materials, utilities, industrials, financials this week. Very interesting to see. However, we did see consumer sentiment miss its consensus expectation, so maybe the consumer not quite feeling what businesses are feeling, but regardless, this is a net positive in aggregate for the economy, and part of the reason why we probably will see higher price action into the end of the year. The economic data looking very good, and Trump trades really were in focus today. Bitcoin extremely close to the 100,000 mark, sitting at 99,000. We probably get to the 100,000 mark next year. By the way, guys, year to date, Bitcoin is up 120%. Tesla shares, another Trump trade, popped 4% on Friday. This helped lift the consumer discretionary sector. Shares of the EV giant are actually on track for a winning week. The stock is up roughly 40% since the presidential election earlier this month over optimism that Elon Musk's support for the president will result in looser regulation around autonomous driving. However, Nvidia was down 3% today, hitting session lows, and I think what we're really seeing is a bit of a rotation out of Nvidia into small caps, into the broader market, and this chart really illustrates that very, very clearly today. And although we did see a net inflow into large cap growth as well as large cap core, what we really saw was money come out of names like Nvidia, Google, and Meta into small caps, growth core value. They really did outperform, as well as the mid cap growth space. So we are starting to see a bit of a rotation, but because of all the liquidity on the sidelines, what we're really seeing is just all sectors gain this week. We had a fantastic week, and again, market breadth today was fantastic. 78% of issues advancing, only 21% declining, and market breadth looking very, very solid. Just last week, market breadth looked horrendous. I always make it a note to mention that the 5-day is very, very noisy, and I did say, guys, any dips we do get, you want to take advantage of them quickly because the longer term trends look very, very robust. And we actually did get a little bit of a dip from last week, Thursday, Friday, into the start of this week, and then we rocketed higher, and that has to do with seasonal factors, buybacks, optimism, economic data, earnings, everything in between, and that is going to support equities into next week. Guys, the Trump trade will continue. I do expect small caps to continue to generate alpha in excess of large caps. A rising tide lifts all boats. So the Trump trade is back, and it will continue into next week. And looking at the charts, guys, very interesting development. Similar to yesterday, the place to be was equities. Now, large caps underperformed small caps as well as the RSP, which is up 0.8%, but the IWM and mid caps, that was the bright spot, up 1.8 and 1.67% respectively. And we're also seeing very green price action in the after hours here. So this bullish fever probably continues into next week, and Trump trades will lead the charge. That's financials, industrials, mid caps, small caps. They're going to be in focus, but don't discount large caps. If you hold the Nasdaq 100, the S&P 500, you probably will continue to see bullish momentum there. So continue to hold those names and buy on any dips that we do get. We actually did see yields pull back ever so slightly. The 2-year yield gained, but the 10-year and 30-year yield continued to move lower. The dollar gained ever so slightly. Actually, the dollar gained a lot, I should say, up 0.43%. Bonds were kind of flat today, and despite a stronger dollar, we saw commodities rise in aggregate, and I think that was in part to, again, the geopolitical tensions in the Ukraine and Russia is still ongoing, and commodities are a hedge. And also, commodities tend to do very well in a cutting cycle and when deficit spending takes hold. And so we're starting to see outperformance here in gold, in silver. Actually, they were the best performing assets here today, even outperforming, actually not outperforming the IWM, but outperforming everything else, mid caps, large caps, and crude as well. So the commodity trade taking shape. And I think if we do see a little bit of a pullback in yields as well as the dollar in the month of December into the end of the year, that's going to bode really well for commodities. So I think if you're looking at gold, you probably missed the rally, but this was a great position to get in right here. I do think we see $3,000 gold. If you miss the gold train, you could probably get into into silver. Silver looking poised to go higher. I think we see higher price action in silver into the end of the year. And I'm not really sure what we're going to do with crude. Very volatile asset class. There's also like geopolitical tailwinds, I hate to say it, for these commodities, as well as monetary tailwinds and cutting cycle tailwinds. Generally speaking, when we cut rates, gold and silver do very, very well in that type of environment. However, let's actually talk about equities. And guys, the gamma zones have not changed all week. What we really saw, however, was the market get into positive gamma. Now, the S&P 500, we saw a very, very small wicks here in the negative gamma area at the start of the week. However, we put a bottom in a low and we just moved higher. And I think based on the seasonal factors as well as buybacks that we have, we probably will go ahead and break the 6,000 level as well as all-time highs. It might not be next week, but definitely before the end of the year. I think we're going to see a couple more all-time highs. All in all, we are in positive gamma for the S&P 500, and that means you buy dips, sell rips. Any pullbacks we do get, you want to buy those pullbacks, especially at the gamma flip, because we will go higher into the end of the year. I think we see anywhere from 6,000 to 6,150 as the S&P 500 close for the year. The Nasdaq 100, what we saw this week, right, was a weekly close above the gamma flip, meaning we're in positive gamma. So that opens up the 2195 area. And guys, if you did miss the move we saw in the RTY this week, you probably pile into large caps. They did take it on the chin a bit this week, particularly in the middle of the week with Nvidia's earnings. However, we should continue to see them outperform into 2025. And this could be a great place for you to get in, because I do think we are going to see all-time highs for this index. So there could be actually alpha in large cap space, but really the momentum trade right now is in the RTY. We are pretty much at the put support. We're going to see if this moves higher. And guys, we are very close. I'm pretty sure all-time highs for the Russell 2000 is like here. That's the line. So I think we have another couple days like this, right, where we just go higher as well as consolidate, maybe break these 52-week highs, and we could see all-time highs in the Russell 2000. I know the market wants Russell 2000 all-time highs before the end of the year. Everybody wants it, because that would just be the icing on the cake, and that would be the signal to get long into 2025. However, I've been a huge proponent of small caps. I said you want to be in small caps, particularly small cap quality, and that's really paying off this week. I mean, in my ETF portfolio, my small cap quality ETF, ticker QSML, has really held things together. However, the Russell 2000 can see a little bit of consolidation here first, maybe even a little bit of downside. But as long as we continue to hold this higher low, we should continue to see movement onward and upward, making higher highs and new all-time highs in the Russell 2000. If the core resistance moves higher next week, that probably means we do go higher. You don't want to step in front of this trend. You really just want to follow it right now. And you guys, we really should be positioned. In last week's video at the start of the week, I said this is the place to get long in small caps. I actually said the same for the S&P 500. I said you want to buy the fear right here. And I said the same for the RSP, and that has paid in spades. The RSP pretty much at an all-time high. That's actually an all-time closing high for the RSP. So congratulations to all holders of the equal weight. And I do believe the Dow Jones actually hit an all-time high as well. Let's have a look. Is that an all-time high? Yes, that is an all-time closing high, not a wick high. That is an all-time closing high for the Dow Jones. Very interesting. How much is the Dow Jones up year to date? Percentage return, 18.23%. That's a very solid year. What about the S&P 500? 27%. The Nasdaq 100 is up 27% as well. And the IWM year to date is up 23%. Guys, it would actually not be crazy to see the RTY outperform the S&P 500 before the end of the year. There's a lot of alpha, a ton of tailwinds. The economic data just is very supportive for small caps at the moment, mid caps as well. The RSP, the broader market, I do think we're going to go higher. I think the macro environment and the earnings environment supports the valuations we see. And guys, when you adjust for return on invested capital, the S&P 500 and the Nasdaq 100 are probably at about fair value. They're not like wildly overvalued. When you adjust for the return on capital as well as these tech names, these sectors and these stocks are really trading at a fair value multiple. They look expensive versus history, but the index composition now versus 10 years ago, 20 years ago, it's not comparable at all. Definitely not comparable at all. I do think if you put money to work right here, you got a long time horizon. I think you should do very, very well in this market. But all in all, guys, I think looking to next week, the Trump trade will continue. And that means you want to be positioned in financials. My preferred financial is PayPal. I really like this name. You want to be in software as well. The software name I like is Paycom. And if you want exposure to small caps, look at something like the CARF index, the US small cap cash cows. It was up 1.59% today, or XSHQ, the small cap quality ETF. Guys, just for the record, this is an all-time high right here for small cap quality. We put in a higher low after the gap up on the election, and we're going to go ahead, break these highs in these small caps. So guys, look at these two small cap ETFs. Look at stuff like PayPal and Paycom for financial. And actually, Paycom is actually considered an industrial. It's in the industrial sector, despite being a software company. So if you're looking for an industrial, look at something like Paycom. I like the intersection between its software and its human capital management. Those two themes go very, very well. It should do very well in the Trump administration. And also, guys, you want to be positioned in companies that aren't really going to be affected by tariffs. And that means domestic industrials, right? And software companies are not really going to be affected by tariffs in aggregate. And that's where you want to be positioned. You also want to be positioned in stuff like utilities. They should do really well under Trump administration. And just equities in general, for the most part, risk assets, they should do really well under Trump administration. If you hold that type of portfolio for the next year, 2 years, 3 years, you should do very, very well. And you should see alpha generated above the S&P 500's return. But guys, we are in a bull market at the moment. And that means any dips we do get, buy those dips, and any positions you have right now, hold, because we will go higher into the end of the year. Now that we're done with the charts, let's look at sentiment. This is the fear and greed index. And right now, greed is driving the US market. Despite all of the volatility we've seen, the upside, the downside, greed is still driving this market. It's been a very volatile period the last 4 weeks. We've been very close to extreme greed. We've moved all the way into fear, neutral, greed, back into neutral. Now we are back into greed. Crazy time period we're in, but that's the price you pay with equities. Volatility is what you get for outsized returns in the market. And for everything we've seen, Goldman Sachs breadth indicator is probably in the middle of the road. Breadth isn't like amazingly broad, but it isn't narrow either. We're in the middle of the pack, and that's because all sectors are simply outperforming, especially when we look at returns year to date. Financials being the best performing sector, up 35.09%. The information technology sector, tech, has underperformed by 4 basis points. Services at 33.45%, and the S&P 500 in total up 26.1%. Absolutely crazy year, a fantastic year. And even the worst performing sector, healthcare, up 9.74%. This is how you know breadth is absolutely fantastic. When the second worst performing sector is literally the average return of the S&P 500 on the last 50 years, 10%. The materials index performing very, very well. Guys, even though this is the worst performing sector and not double digits, this is fantastic returns, all things considered. However, if you are in financials, information technology, and services, you know you are winning and leading the pack. You've seen spectacular returns in the indices, in the individual stocks. And I do think this continues into the rest of the year, because we are moving into a period where we see the end of November rally, and that rally actually started yesterday. And normally this time around November, we normally see a higher low put in, and from there, we actually rally above November's highs with an average return of 1.82%. And if we actually look at the Thanksgiving to Santa Claus rally trade, we see average returns of 2.58% in the S&P 500 and 3.34% in the Russell 2000, with massive hit rates respectively. Now, all things considered, the leader of the rally in the S&P 500 is Nvidia, and we're going to read what Morgan Stanley think about Nvidia and the trade we see over the next 2 months, 6 months, and 12 months respectively. Morgan Stanley say, Nvidia once again reported another quarter of strong growth, reporting year-over-year DC revenue, that's data center revenue, of over 100% for the 6th straight quarter, without any contribution from Blackwell, as H200 revenue was $10 billion plus in the quarter. The company expects Hopper to continue shipping well into the next year, and the crossover with Blackwell is expected to occur in the April quarter. The ramp will continue to put near-term pressure on gross margins, with company commentary for gross margins to dip to the low 70s 70s. That's something we spoke about on the Wednesday video. Gross margins is why the stock sold off on the initial trade after the earnings, with the expectation that they can return to mid-70s growth margins level in the second half of next year. Blackwell is in full production currently following the mask change the company had to make last quarter, and the company now expects to exceed the prior commentary for several billion of Blackwell in Q4. Confidence is clearly quite high on the Blackwell ramp at this stage, with demand that greatly exceeds supply amidst supply constraints and staggering demand. As far as recent investors' debates on the stage of scaling laws, CEO of Nvidia Jensen Huang mentioned that the foundation model pre-training scaling is intact and continuing with ongoing reasoning. Morgan Stanley's first impressions previewed this as a traditional quarter, and reported numbers are roughly in line with the expectations we heard from most investors coming into the quarter. That said, we are not surprised to see the stock down slightly after hours, as there were some high expectations for the initial quarter of Blackwell. Now, this is going back to Wednesday after the release. Shipments in January, as well as management commentary suggesting some additional pressures on gross margins into next year. Overall, the company continues to report very strong numbers ahead of the Blackwell product cycle. All in all, Nvidia is a buy, no big surprise, and long story short, we should see Nvidia move higher, closer to the $200 level into 2025-2026. And as long as Nvidia is expected to be bullish and the earnings are what they are right now, expect markets to follow suit. And diving into the macro, looking at the overall economy, the US economy, the LEI has stopped signaling an impending recession in October. It was signaling a recession for most of the last 18 months. The LEI, or the leading economic index, provides an early indication of significant turning points in the business cycle and shows where the economy is headed in the near term. The largest negative contributor to the LEI this month came from manufacturing new orders, which remained incredibly weak. In October, manufacturing hours worked fell by the most since December 2023, while unemployment insurance claims rose and building permits declined, partly reflected the impact of hurricanes in the southeast US. Additionally, the negative yield spread continued to weigh on the LEI. Apart from the possible temporary impacts of hurricanes, the US LEI continued to suggest challenges in the economic activity ahead. All in all, what we really want to see here is, yes, it stopped signaling an impending recession, but challenges continue to persist because of the manufacturing environment as well as the monetary environment. But all in all, the US Economic Surprise Index continues to move higher. While we did see a little bit of a pullback suggesting a milder, weaker macro, the macro environment is favorable, and that bodes well for the economy, the consumer, and equity markets in aggregate. And jobless claims continues to show that the labor market is continuing to trend at a healthy level. Jobless claims released on Thursday morning came in at 213,000. This was yesterday's numbers, a decline from the prior week. Investors are weighing the Federal Reserve's appetite for interest rate cuts. Traders are now pricing in only a 44% chance of the Fed holding at its December meeting, up from the 28% a week ago, per the CME Fed Watch tool. Weakness in the labor market has been a concern through the summer and into the fall as jobless claims picked up, along with a rise in the unemployment rate and a decline in monthly jobless claims. This data contributed to the Fed's calculus when cutting interest rates by 0.5 percentage point in December. But since then, the labor market has come in better than expected, with the unemployment rate falling from a peak of 4.3% to 4.1% in the last couple of months, and for now, things appear to be okay on the labor side with the Federal Reserve's dual mandate. This is extremely bullish for the labor market. And at the end of the day, when we look at things in aggregate, disposable income and employee compensation has outpaced inflation since the pandemic hit here in 2020. The PCE price index is up 19%, disposable income and employee compensation up 29% and 31% respectively. In other words, consumers are gaining pricing power in the broad economy. This will soon be reflected in every single quartile as long as inflation doesn't re-accelerate.